Hello and welcome to your June Investor Update. My name is George Santa-Olalla and I'm the CRM Manager here at Nutmeg. Now, after several months of filming remotely, I'm pleased to say that this month I'm joined in the office by our Director of Investment Strategy, Brad Holland, while most of the Nutmeg team continue to work remotely. Brad, it's great to see you in person.
Hi George.
Brad, with further easing of lockdown measures in many global economies in May, can you give us a sense of how the markets have performed in the month?
Well, European stocks, they were the star of the show in May, up over 3%, while US large cap stocks rose only by 0.5%. The US technology stocks, the Nasdaq, they were down just over 1%, and US small cap stocks were basically flat. In the UK, large and medium-sized companies were both up around 1%. Elsewhere, emerging markets, they traded quite heavily initially, with Greater China markets the main drag, although this improved as May came towards an end, and the broad emerging market index finished up a few decimal points. Within that, Brazil and India were up over 5%, the real stars there. Commodity prices, well, they had a good month, rising around 4% overall, while the gold price rose 8%. Now, gold did so well as global inflation expectations rose for the fifth consecutive month, and the US dollar approached 7-year lows. Now, this dollar performance can really only mean one thing. Inflation is in the air as economies begin normalizing after the COVID shutdowns. Bond markets, having consequently had a pretty poor year, pretty much consolidated in May. So, well, the big picture really is that the opening up trade, as the normalization has been called, has seen developed equities up over 10% year to date, and bond markets are down between 3 and 8% so far in the year.
Now, you mentioned emerging markets and Nasdaq stocks were key drags in May, but I know the investment team has been favouring those markets for a while. What's going on there?
Well, we shouldn't get too caught up with month-to-month volatility, but it's certainly something we are watching. Year to date, Nasdaq and the broad emerging markets are both up just over 6%, and this compared with around 11% in developed market large cap equities. So there is a definite underperformance since January, but performance over a year ago are very comparable, with 40 plus percentage point gains across the board. We like technology stocks long term because of their profit margins and because of the ever deeper penetration of technology into the fabric of the modern economy. Sure, we expect regulations and global tax reform to trim these tech company profit margins, but they will remain very wide. As long as the global economy continues to expand, which is our view, these companies will enjoy strong business environments. Now, there is always a question about valuations, and we watch this closely to see if it presents shorter-term problems. Microchip supply shortages are another interesting problem as 5G and clean energy demand really ramps up. But we don't see this as a relative weakness for companies that sell technology, quite the reverse. Now, with respect to emerging markets, they would also normally be expected to benefit from a normalization process, which is why we have a slightly bigger position there. And this year, China's stocks in particular have been a dampener as tech companies there have had to adjust their growth models to suit the Chinese Communist Party. We keep all our positions in the fully managed portfolios constantly under watch, but continue to see global cycles rising in sync, and that's a good thing for commodity prices and global trade, and they're environments where emerging markets should do well.
That's an interesting point you make about global cycles rising in sync. Can you dig into that for us a little bit more?
Yes, well, one of the key things we've been looking at over the past 12 to 18 months is when the manufacturing and construction cycles would synchronize. They did so last autumn. And then there was the relative growth trajectories of the US economy and the rest of the world. When would the obvious rebound in North America also be seen in other countries? Services sectors were key to this, and these began to recover early in 2021. So by early this year, global industrial construction and services sectors were all growing, and this led to a liftoff in global trade and commodity prices, both of which had been at depressed levels last year. The supply bottlenecks that we hear so much about at the moment are directly caused by this rapid synchronized improvement. We don't think they are a big concern, just teething pains as the global economy cranks back up.
Thanks, Brad. So how have Nutmeg's fully managed portfolios performed in May?
Well, portfolio performance was pretty flat across the board, with middle risk portfolios up about 40 basis points.
Were there any changes made to Nutmeg's fully managed portfolios in May?
No, none at all. We continue to be slightly overweight equities at the expense of bonds and have a small gold position to add further inflation hedge, as well as to offset what we believe to be a weak dollar environment.
Thanks, Brad. Now this month's customer question is about Bitcoin. Susan asks, I've read your blog on Bitcoin and the current crypto scene. You seem quite sceptical. Don't you think you're underestimating the future importance of digital finance?
Well, thanks for reading the blog and thanks for the question. We are sceptical that anonymity in crypto transactions has a place in the future. That's definitely true. We are sceptical that the current crop of coins is a bona fide investment. Any asset class that moves around to the tweets of just one person, even the great Elon Musk, should really be treated or taken seriously as an investment. But of course, we fully accept and understand that digital ledgers and currencies are the way of the future. And what we are living through at the moment is like the 19th century American Wild West, the rush for land and gold. It's a bit of a no-holds-barred period of discovery. And there is so much at stake that the prize of getting it in early on the global currency is immense. It's just that the winning technology has not yet revealed itself. One thing we do know is that regulation is on the way and that central banks are developing their own digital systems. The Chinese authorities are very progressed on this and are increasingly clamping down on mining and speculative crypto activity. The UK's FCA is currently consulting on high-risk investments, such as crypto, that could be causing consumer harm and or undermine regulatory scrutiny. If the idea of proper regulation is such a concern for the advocates of these assets, well, people should really question why. So we think there is currently too much uncertainty in this space, but we also think it will become a lot tamer and a lot more transparent over time.
Thanks, Brad.
Thanks, George.
And thank you for joining us. Now, if you have any questions for Brad, the investment team, or just something you want answered at the next investor update, then please do feel free to get in touch with us via email, social media, or even in the comments section below. We look forward to seeing you next month.